Hello guys, welcome to lesson 4, and in this lesson we're going to be talking about long-term analysis, and specifically the part of long-term analysis we're going to be discussing on today's presentation is implementing macro analysis and defining open flow liquidity pools for hard time for price action. Now this is going to build upon the concepts we discussed in the previous video using the same pair, which is USDJPY. And on the previous video, we're looking for a run out of this range to run out buy stops up here, and we call this level as a potential drawn liquidity. But the first level, which we called for as a run for buy stop, was this liquidity pool up here, and you can see that we in fact have traded up into that buy liquidity pool, and that lends into the video for today's lesson. Now, all your analysis in the lower time frame will be built off of your understanding of where the fund level liquidity pools are resting on your daily chart. Are they resting on the buy side or are they resting on the sell side? That's what you're constantly trying to define every time you're on the charts and you're looking for a direction premise. Now, the main thing that you want to be doing when you're looking at prices, you want to role play as a central bank. Now, obviously, you're not a central bank. Okay, you're just retail. Okay, we're all under retail. We don't have enough liquidity. No matter how rich you get, you don't have enough liquidity to get into large speculative type level play, or even central bank is exclusive. Okay, you're not getting there ever. Okay, but what we're trying to do is we're trying to, as much as possible, mirror what we believe the algo has to do in terms of efficiency of transaction. And that's the theme throughout the entire course. We're looking for efficiency in transaction. Now, you understand from what I've taught you so far that market driver is based on the relationship between the large banks and the central banks, and it is the relationship between these two entities in form of the provision of liquidity by the central bank to the large speculators that creates liquidity, or what we call order flow in price. Now the question is, how can you define order flow? Okay, how can you anticipate volatility in the marketplace coming? The first you need to define is where there is a drawn liquidity using your look back period. Okay, so remember, your look back period is a 20-day look back, 40-day look back, and your 60-day look back. And what you're really interested in is where will the buy side liquidity pools or sell side liquidity pools on a fund level basis, where would they be resting at? This is what you're trying to define. You're trying to define the liquidity pool of the higher level players, who are the funds or the large speculators. Now, you might say, but Gene, you said in the last video that when prices running higher, the central banks are being counterparty to the funds or buying, while the central banks, create buy side liquidity for the funds to allow sponsorship on the buy side. So if the funds are buying, well then, why are we looking for a buy side liquidity pool for the funds to be cannibalized up here? Now, you need to understand that when we say the funds, we don't mean every single fund is going to the marketplace and as market rallies higher, because that is market efficiency paradigm. Okay, that's a hedging program. As the market declines lower, the central banks will build in along as the market drops. And then as the market starts to rally, they will start to offer that buy side liquidity they've been building in. Okay, and that's how they offer liquidity to the funds. Now, the central banks, okay, they have deeper pockets because they own the asset. Okay, so they can see on the water for a long period of time because their job is to provide liquidity. Excuse me. Okay, so their job is to provide liquidity. But now you have to remember, as they offer buy side liquidity to the funds, there are going to be other large speculators who are short or who are holding short positions inside this parent price swing. Okay, if we can drive the market up here, and I'm trying to role play as a central bank, okay, I'm trying to use that example. If we can drive the market up above the short-term high, or even up into a premium, then that is enough to offset some of the funds who are short and then we can have what we call counterparty transactions for the central banks. Now, going back into our definition of order blocks, you can see we have two consecutive down candles here, and I think I've gotten the question a couple times. When you see a multiple down candles, which one do we use for our order block? If you have two consecutive down candles, that is your bullish order block. As soon as price trades up above this, the second down candle, or the first down candle, this is the second down candle. So as soon as price trades up above this first down candle on a closing basis, the two candles becomes automatically a bullish order block. Now, in this example, where you have 1 and 2 and 3 down candles, which becomes your bullish order block? This does not become a bullish order block until this candle trades up above the opening price. So when do you validate a order block? And now this applies to all time frame, not just necessarily the daily time frame or maybe monthly or weekly time frame. It also applies to a 1 minute time frame or a 5 minute time frame or a 30-second time frame. Again, it's all universal. The concepts are all universal price. Okay, so this does not become a bullish order block, nor this, until this candle trades up above. Now, here, this is a bullish order block. As soon as this candle trades up above this candle, that's a bullish order block because that's a down candle preceding institutional order flow. Why would that be institutional order flow? Because the assumption is that here, where we're at the run the sell side and trade down to discount, we should see sponsorship for this buy side liquidity, or at least up into a premium. Okay, and what's going to be the premium during liquidity? This inefficiency here, and then this bearish order block. That's a premium. Okay, and we're using the idea from the previous lesson where we had smart money divergence at this low after running out a parent price swing, where there would have been large fund sell side liquidity pool, and after we ran through below that, we saw a willingness to run lower while the low is running lower, so which shows a lack of symmetry and underlying relative strength on dollar yen. Okay, and then that was also supported with our open interest analysis that indicated that we had a quarterly shift on USDJPY. So the underlying premise is we're on a quarterly shift basis, we're bullish. So this run lower, we're not looking at this as continuation for bearishness. We're actually looking at this as a run down into a discount inside the experience price swing. Okay, so from that's from this low here to the eye up here. That's a run down to discount, and we're wanting to see higher level funds stepping into the marketplace and start to building their own positions as the central bank starts to offer buy side liquidity to these fund market participants. Okay, so here, okay, with that underlying premise from our quarterly shift basis. Now, what I want you to watch here with the long-term analysis is I want you to watch how I am transposing our quarterly shift analysis using the look back period, using the open interest into our daily buys or our daily order flow. So I'm looking at this as we have a run on sell stop at a discount, a trade down into a balanced price range. Our rule or protocol for a balanced price range is not validated because the market does not trade through the consequent encroachment of our BPR. So it shows very strong willingness to want to displace away from there. So as soon as the trades on there, look at the next candle, trades higher. Now, REITs is going to call this a bullish engulfing. We're not concerned with the candles. What I want you to see is how we are respecting discount. Now, what is the basic definition of order flow, regardless of any time frame? What is the definition of order flow? Definition of order flow to determine if order flow is either bullish or bearish is market respecting discount arrays and validating premium arrays, or is the market respecting premium arrays and validating discount? Now, at discount, we have a couple of discount PD arrays or reference points. We have a balanced price range here, and we have a rule of engagement for a balanced price range, meaning we want to see price trade through the 50% of the range, which is what we call consequent encroachment. Okay, that's number one. And as price trades on there, you can see we have displacement away from there. Now, we also have another discount. If you go all the way back, this is the old low from this parent price swing. Okay, from this low here all the way up to the eye there, that is our initial parent price swing. You can see that that also comes in as a confluence inside our breaker block. Look at what the market does. Trades down into that old low and then displaces. Now we have a shift in structure because this was the last short-term high up here. As soon as the market shifts structure, now 1, 2, 3 becomes a bullish order block. But until this candle forms, our bullish order block is this. Now you're gonna look at this and say, but this candle trades up above this candle also. So why is our bullish order block not 1, 2 down candles as a bullish order block? The reason why is because when you're using consecutive down close candles for a bullish order block, and what I'm teaching here, just simply reverse that for the sell side. Okay, so when you're using consecutive down close candles for a bullish order block, you're not interested in the candles in between. You're only interested in the last candle preceding expansion or the candle that starts all the downwards delivery preceding expansion. So even though we trade up above this candle, we're not looking at that as a bullish order block until this candle trades through, and then we take all of this together as one down candle. Okay, and so if you take all of these together as one down candle, the mean threshold, again, when you're looking for the mean threshold, or which is 50% of a bullish order block, you use the candlestick bodies, not the wicks. And if you took everything into consideration, you can see that's what we're trading down into on USDJPY. Okay, here we trade down there, and then we'll trade down there, and then we'll see institutional sponsorship. As soon as this candle closes above this down candle, you have a propulsion block. Remember the definition of propulsion block? So go back to your module 1, study what I taught you about propulsion blocks and what should follow. Okay, you need to see displacement like this. Where should the market displace up into? Where is the nearest fund level buy-side liquidity pool? It's going to rest above daily highs and daily lows, and this is the basic framework for your weekly range profile and all your short-term trades. Every day trade and short-term trade you're ever going to take has to be built upon your anticipation of the drawn liquidity on a fund level basis using your daily order flow. That's why a very important premise for your anticipatory skill set in terms of your analysis or your prognostication for a day trade has to be, can you define clearly what daily order flow looks like? Can you identify clearly where the drawn liquidity for the daily time frame is? If you cannot identify clearly, then that already or automatically is low probability. Why? Because what we're doing is we're trying to be on side with the provision of liquidity by the central banks to the funds. So we want to be on side with order flow. That essentially is what order flow is. Order flow by definition is simply provision or the intermarket relationship between central banks and fund level liquidity. That is definition of order flow. So all we're doing on the lower time frame, all we're trying to do when we are anticipating a move or looking for execution is we're trying to be on side with order flow, daily order flow, and then we can use our lower time frame to get in sync with daily order flow, but without defining, which is the framework. That is the entire framework for our lower time frame analysis and execution and management. It is the understanding of where the draw liquidity is for the daily order flow. And I know this is the more boring part of the course, but this is the most important part of the course, which I think I've mentioned this before. Without a very fundamental understanding of daily order flow or a fundamental understanding of the relationship between central banks and the funds, you are essentially handicapping yourself in terms of analysis as an institutional trader. And this is where so many people get caught up. They want to trade the 1 minute time frame because everyone else on Twitter is doing so and it looks cool. But they don't understand that for you to do that efficiently, you need to understand what your daily time frame is doing. Because if you can understand what your daily time frame is doing, then you can break it down to a 5 second, matter of fact, you can break it down to a 5 second price delivery at a very specific time window, looking for displacement in direction of daily order flow. Why? Because the lower time frame will always be used to get in sync with higher time frame price delivery mechanism. Okay, when you see a daily bullish candle, the lower time frame would have been bullish. Otherwise, you're not gonna see a daily bullish candle. Okay, so it all stems from understanding where the drawn liquidity is. So your analysis in terms of long term is all about role playing. You are trying to understand, or you're trying to define with a very clear prognostication where the fund level liquidity would rest, using your look back period, using your quarterly shifts, and using open interest to support your analysis. Again, when you're using your look back period, you're not just using highest high and lowest low in the last 20, 40, or 60 days to identify buy sell liquidity pool. Okay, you're identifying all the PD areas of reference points at premium. You're also identifying all the PD areas and reference points at discount. Then you're using that to build upon your analysis to identify what or when the market should be displacing into a target draw on liquidity. So the question you're asking yourself is, where is the near term buy sell liquidity pool or sell sell liquidity pool in the last 20-day range? And also, where's the near term buy sell liquidity pool or sell sell liquidity pool in the last 40-day range? And where's the near term or the long term buy sell liquidity pool or sell sell liquidity pool in the last 60-day range? That's where you're identifying. And what you're looking for is you're looking for a willingness in the marketplace to want to displace to your objective. You don't want to see the market arm wrestle your buys. Just like you saw in the last lesson, there was no arm wrestle over buys. It was immediate displacement to our objective. This indicates that we're on side with order flow. If we're not on side with order flow, there will be a struggle in terms of displacement. But you can see, as soon as the market trades down into, so I use this line here, is the main threshold of these two down candles. So if you measure your range from the opening price of this first candle to the closing price of the second candle, your main threshold comes around here. So as soon as the market trades down into an essential discount, which is our bullish order block, again, that's a discount because if you use your range measurement, you can see it goes below the equilibrium of the trading range. So again, that goes back into the lesson we did on equilibrium versus discount and premium, and how the market references discount, okay, for displacement higher, okay, into premium. Okay, so now the market trades down into a discount, and you can see as soon as the market trades down to a discount, you can see a willingness to want to trade away from there. Next candle trades higher, next candle follows through with displacement into a premium array, which is a bearish order block. And if you were going long, you would have your near-term objective here, a short-term objective here, near-term objective is here, and longer-term objective up here. And I think personally, if we can trade up into this, then we might possibly start to consider all of this premium, and even possibly even this range at a premium for market delivery on dollar yen. Now, what I want you to also watch is look at what dollar is doing. Okay, dollar is not displacing really. It is, matter of fact, it is even trending lower. And during the period where dollar was running lower, you can see USJPY was also trading lower. Okay, you can see the lower prices in USJPY. And as soon as we trade down into the balance price range, and we had a shift in structure, okay, we made a higher low on dollar yen. Meanwhile, dollar was making a lower low. Dollar was showing a lack of willingness to want to trade higher. So what does this indicate for dollar yen? What does that mean? That simply means that we have underlying sponsorship on dollar yen. Okay, we're seeing a willingness to want to displace against a reference asset. This is our underlying, which is dollar yen. That's the underlying. The reference asset is dollar. And we're seeing a lack of willingness to want to trade in sync with dollar, and we're seeing relative strength on dollar yen. So what this could mean is we could see possibly a trend reversal on dollar. Okay, we could see dollar shift order flow long term and actually start to rally. Okay, so if we're going to look at dollar and see what dollar is doing right now, you can see that dollar is still at a discount, still inside the consolidation after on our buy side. Okay, so that could mean possibly that we could see a longer term run higher on dollar if we get out of this consolidation. For now, dollar is still in the consolidation, and we don't know what dollar is going to do yet. But again, going back into the lesson I did between underlying versus reference. Okay, we have our underlying running higher. Okay, one of them has to give way. One of them has to eventually get in sync. Now they can stay. If dollar yen is rallying, okay, and dollar wants to trade lower, then dollar has to be out in consolidation to allow for dollar yen to run up into buy side. Otherwise, if dollar yen continues to rally strongly, then dollar has to eventually give way and get in sync with price delivery, because we're seeing that there's an underlying fundamental strength on dollar against yen, which is a major asset. Okay, so one of them is going to eventually have to catch up. What I'm defining here is you can see that there is a very strong order flow behind dollar yen, okay, which supports your analysis using the quarterly shifts. And so in this example, all you're doing is you're identifying your buy side liquidity, where the funds will have protective buy stops in a bullish order flow. So that's going to come above old highs, and that's going to come at inefficiencies at a premium, because again, a bearish inefficiency is a buy side liquidity pool. A bullish inefficiency is a sell side liquidity pool. Again, inefficiencies are simply forms of liquidity pools, which I've taught. I think I've taught this on module 1. Okay, so if you were buying down here using this as a bullish order block and using this as a propulsion block, or using all of this as a bullish order block and then using this as a propulsion block, your first or short-term objective as a swing trader is going to be up here, where you have the nearest drawn liquidity, which is this short-term daily high, and that's going to be buy side liquidity pool. And then your next target drawn liquidity would be this fair value gap. Okay, so that is going to be the high of this candle to the low of this candle as a fair value gap, and that is what you're targeting. And you can see the response there, and you can see as soon as we trade up above buy side liquidity pool 1, you can see the distribution that comes in the marketplace, and then the market retraces down again into a discount. Okay, and then sees displacement into our bearish fair value gap, which is also a buy side liquidity pool. Okay, which is what I've taught before. Why is this a buy side liquidity pool? Because we have only delivery on the sell side, but there is no delivery on the buy side. So we have sell side delivery, but a lack of buy side. So we have an absence of buy side delivery, but a presence of sell side. So it is efficient only on the sell side, but inefficient on the buy side. So that creates a pool of buy side liquidity, because we need to go and fill that on the buy side. Now that goes back into our initial analysis of what the function of the algo does in terms of price delivery. Or if you watch the lesson I did on market efficiency paradigm, and now the market has to deliver efficiently for liquidity and inefficiency, you would understand that they're both two sides of the same coin. Okay, the market moves primarily on the basis of liquidity, and inefficiencies are simply just one form of liquidity in price. Actually, in summary, what we're looking for constantly in terms of our daily prognostication is we're looking for sponsorship. We're looking for very clear sponsorship in price, and we don't want to see the market arm wrestle with our anticipated journal liquidity. So if we're looking for buy side liquidity pool as our journal liquidity, then we don't want to see the market arm wrestle with us, and we want to see immediate displacement for our target buys. Now, if you look at dollar right now, dollar's doing nothing. Okay, dollar's neither going higher Dollar is neither going lower, and this is what creates a low probability market condition. And you've seen our results over the last couple of weeks. Okay, it's not been the winning streaks that you're used to. It's been more of wins here and losses here, and wins here and losses here. All right, because we are trading in low probability market condition. There is no willingness to want to displace. So what does that indicate to you as an institutional trader? There is no sponsorship. Without the presence of sponsorship, you essentially are going to the market blindfolded. Now, obviously you can go into the marketplace in the lower time frame. You can trade lower time frame displacements, right? Because just going to be the same concepts we'll teach in the higher time frame. Also going to apply to lower time frame, but it's going to be extremely difficult because you're not going to get one-sided market environments. Instead, you're going to get whipsaws around, and the market just goes back and forth. Whenever you see sided market conditions or a lack of displacement, that shows that on the higher time frame, and again, this is what we're talking about, and we're emphasizing higher time frame price conditions. This shows on the higher time frame there's a lack of sponsorship, or there's a lack of willingness to reach for either side of the market in terms of liquidity pools. There's a lack of willingness in price to displace either liquidity pool, and this creates low probability market conditions. And that's why I've seen over the last couple of weeks that there's been a lack of symmetry between the assets. Okay, dollars in a consolidation, US CAD is rallying, Euro dollar is rallying, cable is rallying, Aussie is declining. There's no correlation. There is no correlation because dollar is not doing anything. Dollar is stuck sideways. Dollar is not showing any willingness to want to displace, and this creates for low probability market conditions. And this is where you use your long-term analysis, identifying draws on liquidity and looking for institutional sponsorship, which means, again, definition of institutional sponsorship simply means willingness and price to display to a level of liquidity. If there's a lack of willingness and price to display to a level of liquidity, either on the buy side or sell side, that is low probability because there is no clear institutional sponsorship. I'm going to wrap up the video here, and on the next lesson, we're going to talk about institutional swing points, and I will catch you on lesson 5 of the higher time frame module. Trade safe.